3. Strategic alignment and assessment of resources. Budgets as strategy tools. An organization's budgets support strategic decisions by allocating limited resources to programs and activities that improve the organization's ability to achieve its strategic goals. Strategic budget alignment occurs at both the organizational and functional levels. Budget is essentially a planning and measurement tool. It provides control over assets and transparency over the use of those assets. Budgeting process. The budgeting process varies in different organizations. Some use a collaborative, top-down, bottom-up process in which organizational and functional leaders present budget goals and guidelines and departments respond with proposed budgets. The final budget is usually the result of negotiation. Budgeting methods. Incremental, zero-based, activity-based, formula-based. Traditional form of budgeting, also known as line item budgeting. The prior budget is the basis for the next budget. Installing new computer equipment requires a separate budget request. All objectives and operations are given a priority ranking. Each unit or goal is ranked, and then available funds are given in order. A department would need to justify its entire budget. The basis for budgeting is not how to divide a set amount of money but how much it costs to perform different enterprise activities. Resources needed to produce specific outputs or levels. Different units or operations receive varying percentages of the budget. General funding is changed by a specific amount, and the unit budgets are adjusted accordingly. A system-wide 5% budget decrease. Note that budgeting process requires understanding the organization's practices, strategy, and environment. Because human resources spans the entire organization and because functional strategies and plans will inevitably affect HR operations, one of the challenges of developing a strategic HR budget is being aware of the human resource needs of internal business partners. HR budget. The HR budget includes ongoing operational costs related to HR's essential services, such as recruitment and selection, employee relations activities, and talent management. Overhead costs that do not directly contribute to HR function and service provision, such as utilities, maintenance, and other costs related to occupancy. One-time project costs planned to support HR strategy and objectives, for example, an executive salary review. The operational side of the HR budget includes resources that are directly related to staffing and expenses required to provide HR services to internal customers. This budget ordinarily includes resources related to talent acquisition, training and development, compensation and benefits, employee and labor relations, health, safety, and security, information technology, planning, philanthropy, creating a business case to secure resources. A business case is a presentation to management that establishes that a specific problem exists and argues that the proposed solution is the best way to solve the problem in terms of time, cost efficiency, and probability of success. Whether they are written or oral, business cases generally have the same components as follows. Executive summary. This summarizes and establishes the purpose of the project. Recommended solution. The objectives for an ideal solution are defined in detail. Risks and opportunities. Consider risks that could impact project success, present new opportunities, or result from inaction. Estimated costs and time frame. The project budget should include all foreseeable elements. The time frame needed to accomplish the project. Financial statements as measure of business performance and health. Understanding the financial statements helps the HR professional understand the perspectives of internal and external stakeholders. HR professionals can better understand the economic issues driving management decisions. Identify opportunities for HR to improve the organization's financial performance, for example, developing new competencies aligned with financial goals. Understand factors that may affect HR strategies. For example, weak revenue may affect executive compensation. Balance sheet. The balance sheet is one indicator of the organization's financial health. It is a statement of the organization's financial position, its assets, liabilities, and equity, at a particular time. Every financial transaction is an exchange, and both sides of the transaction are entered on the balance sheet to reflect assets, liabilities, or equity. Only transactions measurable in money are recorded. Transactions without a definite monetary amount are not placed on a balance sheet. Equity is combined with liabilities in the balance sheet because it represents what a company owes to either its owners or its shareholders. The relationship between assets, liabilities, and equity is represented by the balance sheet equation, which may be shown as assets equals liabilities plus equity or equity equals assets, liabilities. Assets are what an organization owns. They can be tangible or intangible. Human capital is not considered an asset because it cannot be monetized. Assets also include investments the company has made, and what is owed to the organization, accounts receivable. Current assets include items that can be easily liquidated or converted into cash. Fixed assets have tangible value but are not intended for quick liquidation. Income statement. Unlike the balance sheet, the income statement compares revenues, expenses, and profits over a specified period of time, usually a year or a quarter. The income statement is also known as the profit and loss statement or P&L. It provides key information about the organization's performance. The income statement indicates an organization's net income, which is often referred to as the bottom line. Net income equals revenues, expenses. Financial data in the income statement is used to create metrics for an organization's financial health. Two key metrics from the income statement, for example, a gross and net profit margin. Remember that gross profit is net sales minus the costs of producing what is sold. The gross profit margin compares gross profit with sales. It is calculated in the following way. Gross profit divided by net sales equals gross profit margin. Net income is what is available for reinvestment or for distribution to owners and stockholders. The net profit margin is calculated in the following manner. Net income divided by net sales equals net profit margin. Note: owner withdrawals are not an operating expense but are a distribution out of net income. Cash flow statement. The cash flow statement illustrates the effect of all organizational activities that both consume value, for example, production, administration, and produce value, for example, sales, investments, on how much cash or cash equivalents the organization has on hand. In other words, the cash flow statement shows how money is flowing into and out of the organization, through operations, investing, and financing, over a defined period of time. There are three areas in a cash flow statement: operations, positive cash flow and negative cash flow, investing, financing. For an HR professional, poor cash flow may mean that fewer resources will be available for HR programs, but there may also be opportunities for HR to use its expertise to improve the cash flow situation. Financial and non-financial ratios as indicators of business health. Financial ratios are another important tool that can be used to analyze an organization's performance. Current ratio equals current assets, current liabilities liquidity ratio that indicates level of working capital. Debt to asset ratio equals total liabilities, total assets. A number greater than 1 indicates that an organization has more debt than assets. Debt to equity ratio equals total debt, shareholders' equity leverage ratio reflecting how an organization is funding its growth. Accounts receivable turnover equals net credit sales, average accounts receivable activity ratio that measures the efficiency of debt collection. Gross margin equals total sales, cost of goods sold, total sales. EBITDA margin equals earnings before interest, tax, and depreciation, total sales used as measure of management performance. Profit margin equals total sales, total costs, total sales profitability after all expenses have been deducted. Return on investment, ROI, equals gain from the investment, the cost of the investment, a good investment generally greater than 1. Earnings per share, EPS, equals net income, the number of outstanding shares used by equity holders as a standard expression of earnings. Price to earnings, PE, equals stock price per share, earnings per share market value ratio that indicates market confidence in the organization's ability to maintain or increase earnings. Non-financial performance measures. Non-financial measures examine changes in areas that are not measured in terms of currency but whose effects can be monetized to show their financial effect. Such measures might include: share of market, achievements in social responsibility, efficiency, activity ratios, employee retention and job satisfaction ratings, employee engagement, market position, reputation, level of brand awareness among consumers, recognizable employer brand and quality. Conducting a SWOT analysis can help identify which of these measures, or others not listed, are most relevant to the organization's strategy. Sales pipeline. The sales pipeline is a visual representation of an organization's sales process. 1. Identify leads. Through campaigns, public relations, and other promotional activities. This stage is sometimes referred to as prospecting. 2. Gather information. Investigate prospective customers to ensure that they are viable leads. 3. Create proposal. After it is determined that a lead is legitimate, a proposal is drawn up detailing how and why the product meets their requirements. 4. Negotiate. After receipt of the proposal, a prospective buyer might come back with a counterproposal. 5. Close sale. After the terms have been agreed upon, a contract is sent out and signed by both parties, and payment is received. 6. Monitor. After a sale is completed, the customer should be monitored regularly in order to provide high levels of service. Business documents. HR professionals should familiarize themselves with a variety of non-financial business documents, including the following, as a source of information that can help to inform and refine strategies and plans. Business plan. The founding document for an organization and an organizational level equivalent of a business case. The business plan includes details of the organization's structure, its marketing plan, and financial projections. Strategic plan. This document outlines how an organization intends to fulfill its purpose. It includes details of the mission and vision, strategic objectives, goals, and initiatives, and relevant budgetary information. It is a more detailed version of a business plan. Organizational chart. This is a diagram that illustrates the hierarchy within an organization. It includes information regarding reporting and other relationships between individuals, functions, and departments. Standard Operating Procedures, SOPs. These are formal guides, typically presented step by step, that outline how a work process or activity should be completed. Many of HR's functions might have SOPs: hiring, employee onboarding, training, exit interviews, annual reviews, and so on. Grants. A grant is a form of financial assistance provided by a government to help fund an idea or project that is understood to provide a public service or stimulate the economy. Contracts. A contract is a legally binding agreement between two or more parties, typically related to the exchange of goods, services, or cash. It defines and governs the rights and responsibilities of each participant. Business continuity plans. A document that outlines how an organization will maintain operations during an unplanned disruption. HR will have its own plans for disruptions, but a business continuity plan takes into consideration every aspect of an organization that might be affected.